There's one chart pattern that can mean the difference between a huge win and a crushing loss: the head and shoulders. It's the market's way of sending a clear signal, if you know how to spot it. Today, I'll show you exactly what it is, how to recognize it, and how to use it to protect your trades or catch big moves. We'll break down the psychology behind the pattern, real-world examples, and the key steps to trade it confidently. By the end, you'll have a practical skill that can transform your trading results. Let's dive in. So, what exactly is the head and shoulders pattern? It's a formation that appears on trading charts and can provide valuable insights into potential market reversals. Understanding this pattern can be a game changer in your trading strategy, offering clues about when a trend might be losing steam and potentially reversing direction. Picture a chart after a strong uptrend. Imagine the price steadily climbing, reflecting a period of bullish sentiment and increasing investor confidence. This is the environment where the head and shoulders pattern often begins to take shape. Now, visualize three distinct peaks forming on the chart. These peaks are the key components of the pattern, each telling a story about the shifting dynamics between buyers and sellers, with the middle one, the head, being the highest. This peak represents the strongest surge in price during the uptrend, a point where buying pressure reaches its zenith. And the two sides, the shoulders, lower and roughly equal. These shoulders indicate a weakening of the uptrend as buyers struggle to push prices to new highs. This pattern signals a potential reversal. It's a warning sign that the prevailing uptrend may be losing its momentum and could soon give way to a downtrend, warning that the bulls are losing steam. The pattern suggests that the buying pressure that fueled the uptrend is starting to wane, and sellers are beginning to gain control, and the bears are ready to take over. This shift in power can lead to a significant decline in price, as sellers become more aggressive and buyers become more hesitant. It's not just a random shape. The head and shoulders pattern is a meaningful formation that reflects underlying changes in market sentiment and buying-selling dynamics. It's a shift in market sentiment. It represents a transition from optimism and bullishness to uncertainty and potential bearishness. A battle where buyers are running out of energy. The pattern indicates that the buying pressure that sustained the uptrend is becoming exhausted, making it difficult for prices to continue rising. Here's how it unfolds. Let's break down the formation of the head and shoulders pattern step by step, examining the key stages and what they signify. The left shoulder forms after a rally, followed by a dip. This initial rally represents the continuation of the existing uptrend, while the subsequent dip signals the first sign of potential weakness. Then, buyers push to a new high, the head, before another dip. This new high represents a final attempt by buyers to maintain the uptrend, but the subsequent dip indicates that their efforts are faltering. The right shoulder forms when buyers try again. This is the last gasp for the bulls, a final attempt to regain control and push prices higher, but can't reach the previous high. The inability to surpass the head's high is a crucial signal that the uptrend is in serious trouble. This failure to make new highs is a classic sign of weakening momentum. It confirms that the buying pressure is diminishing, and the sellers are gaining the upper hand. I once knew a trader, Alex. He was a seasoned investor, confident in his abilities, but even the most experienced traders can sometimes miss critical signals. Who ignored this pattern? He was so focused on the potential for further gains that he overlooked the clear warning signs presented by the head and shoulders formation, and watched his profits vanish as the price collapsed after the neckline broke. Alex learned a hard lesson that day about the importance of recognizing and reacting to chart patterns. The head and shoulders isn't just for stocks. This versatile pattern can be observed across various financial markets, providing valuable insights regardless of the asset being traded. You'll see it in forex. Currency traders often rely on the head and shoulders pattern to identify potential reversals in currency pairs. Crypto. Even in the volatile world of cryptocurrencies, this pattern can provide clues about potential trend changes. And commodities too. From gold and silver to oil and gas, the head and shoulders pattern can be a valuable tool for commodity traders. The key parts. To effectively identify and interpret the head and shoulders pattern, it's essential to understand its core components. Left shoulder, head, right shoulder, and the neckline, a support line connecting the two troughs. This line acts as a critical support level, and its breach can signal a significant shift in market dynamics. The pattern is confirmed when the price breaks below the neckline. This breakdown is a strong indication that the bears have taken control and a downtrend is likely to ensue. That's the moment traders look for to enter or exit positions. A break below the neckline can be a signal to sell long positions or initiate short positions, depending on your trading strategy. My tip: always scan for this pattern after a big run-up. Periods of strong upward momentum are often followed by corrections or reversals, making the head and shoulders pattern particularly relevant in such scenarios. It can save you from disaster or highlight a golden opportunity. Recognizing this pattern can help you avoid potential losses by exiting positions before a downtrend begins, or it can provide an opportunity to profit from the anticipated decline. Don't ignore it. Make it part of your pre-trade checklist. Incorporating the head and shoulders pattern into your routine analysis can significantly improve your trading decisions. The head and shoulders is your early warning system for trend reversals. It provides a valuable heads-up about potential shifts in market direction, allowing you to adjust your strategy accordingly. Once you learn to spot it, you'll see it everywhere. With practice, you'll develop an eye for identifying this pattern quickly and accurately, making it an invaluable asset in your trading toolkit. It's like learning a new language for reading the market. Chart patterns are a form of visual communication, conveying information about market sentiment and potential price movements. Remember, it's not about predicting the future. No chart pattern is foolproof, and the market can always surprise you, but about managing risk and stacking the odds in your favor. By understanding and utilizing chart patterns like the head and shoulders, you can make more informed trading decisions and improve your overall profitability. Don't be like Alex. Recognize the signs before it's too late. Learn from his mistake and make the head and shoulders pattern a key part of your trading strategy. This pattern is your edge in the chaos of trading. It provides a framework for understanding market dynamics and making informed decisions, giving you a distinct advantage in the competitive world of trading. Let's zoom in on the left shoulder. We're going to dissect this initial phase of the head and shoulders pattern, understanding its nuances and what it signals about the market's underlying sentiment. This is where the seeds of a potential reversal are sown, and recognizing it early can give you a significant advantage. The first hint of a reversal. It's a subtle clue often overlooked by novice traders, but it's a critical piece of the puzzle. After a strong rally, prices hit a new high, then pull back. This initial surge represents the last gasp of the bullish trend, a final push before the tide potentially turns. Most traders see this as a normal dip, a temporary pause in the upward trajectory. They might attribute it to profit-taking or minor market fluctuations, but it's the first clue that buying pressure is fading. The enthusiasm that fueled the rally is starting to wane, and the market is beginning to show signs of fatigue. The psychology early profit-takers start selling, locking in their gains after the recent rally. This selling pressure contributes to the initial pullback, or some think the asset is overvalued. They believe the price has run too far ahead of its intrinsic value and are taking the opportunity to reduce their positions. The price dips, forming a trough. This trough marks the end of the initial pullback and sets the stage for the next phase of the pattern. Volume matters here. It's a crucial indicator that can confirm or contradict the signals we're seeing on the price chart. If the rally to the peak is on strong volume but the pullback is on rising or steady volume, it could mean smart money is selling. Large institutional investors who often have access to more information and sophisticated analysis may be quietly exiting their positions. For example, imagine a hot stock surges to $102, fueled by positive news and investor enthusiasm, then pulls back to $95. This pullback might seem insignificant in the grand scheme of the stock's overall performance. News is still positive, reinforcing the bullish narrative and encouraging investors to hold on. But that dip is your first signal. It's a subtle warning sign that shouldn't be ignored, especially if accompanied by the volume patterns we discussed. Don't jump to conclusions. Acting prematurely can lead to costly mistakes. One peak and dip isn't enough. We need more information to confirm the potential head and shoulders pattern. The left shoulder is just the setup. It's the initial act in a play that's about to unfold. Mark the peak and trough on your chart. This will help you visually track the pattern's development and identify key levels. And watch for what comes next. Pay close attention to the price action and volume as the pattern evolves. A common mistake: turning bearish too soon. It's tempting to short the stock as soon as you see the left shoulder, but that can be a risky move. Wait for the full pattern. Confirmation is key to avoiding false signals and increasing your chances of success. My tip: watch volume closely. It's the fuel that drives price movements, and it can provide valuable insights into the strength of the trend. High volume on the way up, followed by a pullback on strong or rising volume, can be an early warning. This combination suggests that selling pressure is increasing and the bullish trend may be losing momentum. If the rally is already on weak volume, indicating a lack of conviction among buyers, the uptrend may be losing steam. This makes the left shoulder an even more significant warning sign. The left shoulder is the market's first subtle hint that the bulls are tiring. They're losing their grip on the market, and the bears may be preparing to take control. Don't act yet, just pay attention and get ready for the next phase. The market is about to reveal its intentions, and you need to be prepared to react accordingly. The left shoulder is the first cough before a cold on its own. It's nothing, a single data point that could be easily dismissed. But in context, it's a warning. When combined with other indicators and a broader understanding of market dynamics, it becomes a valuable piece of information. Be patient and observe. Let the market tell you its story. The real action comes next. The formation of the head and the right shoulder will provide further clues about the potential reversal. This is where your edge begins. By recognizing the left shoulder and understanding its implications, you're already ahead of the curve. Stay alert for the head. It's the next critical piece of the puzzle, and it will provide further confirmation of the potential head and shoulders pattern. Now, the head forms the highest peak after the left shoulder. Bulls push prices to a new high, but this is often their last burst of energy. The rally to the head may look strong, but check the volume. If it's lower than before, that's a red flag. Smart money often sells into this euphoria while late buyers rush in. After the head forms, prices drop sharply, often back to the previous trough or lower. This second dip is crucial. It helps define the neckline. The pattern is now taking shape: two peaks, two troughs. The bulls tried but couldn't sustain the rally. My tip: confirm the head with both price and volume. A weak rally to a new high followed by a sharp drop is a strong warning. The head is the climax, the bull's last stand. Watch for exhaustion and a decisive decline. The balance is shifting to the bears. Get ready for the right shoulder. After the head, the price recovers, but the rally is weaker. This forms the right shoulder. The right shoulder's peak is lower than the head, showing the bulls can't regain control. Volume is usually lighter, and sellers step in as the price nears the left shoulder's level. The uptrend is officially challenged. No new highs, just a lower high. The pattern is now clear. Left shoulder, head, right shoulder. Don't get fooled by a brief rally here. Bull traps are common. Wait for confirmation before acting. My tip: be wary of false signals. The right shoulder often looks convincing, but if it stalls below the head, sellers are taking over. The right shoulder is the market's last gasp for the bulls. Once it forms and prices start to drop, the pattern is complete. The neckline is now in focus. The tension is high. One more move could trigger a big shift. Stay disciplined and patient. The real opportunity is about to appear. Watch the neckline closely. Now comes the critical moment. The moment of truth that separates successful traders from those who hesitate. This is where understanding chart patterns can truly pay off. The neckline and the breakout. These are two key elements that can signal a significant shift in market sentiment. The neckline connects the lows after the left shoulder and the head. It's the line in the sand, the critical support that bulls are desperately trying to defend. A key support level. This level represents a price point where buyers have historically stepped in to prevent further declines. When the price closes below the neckline, decisively breaking through that support, it's confirmation that the trend has reversed. The bears have taken control and the market is signaling a potential move downwards. The more times this level held before breaking, the more it was tested and defended, the more powerful the move. A well-defended support-turned resistance can lead to a rapid price decline. A decisive break below the neckline, a clear and unambiguous move, is the trigger for many traders to enter short positions, capitalizing on the anticipated downward momentum, or exit long positions, cutting their losses and protecting their capital. Volume matters. It's the fuel that drives the market. A breakout on high volume is more convincing. It indicates strong conviction behind the move, suggesting it's more likely to be sustained. Don't jump in on an intraday dip. Be patient and disciplined. Wait for a confirmed close below the neckline. A closing price below the neckline provides stronger evidence of a genuine breakout. Sometimes the price will retest the neckline from below, testing the waters, so to speak. This can be a great entry if it holds as resistance. It offers a lower risk opportunity to enter a short position. Avoid the common mistake of acting before confirmation. Impatience can be costly in the market. False breakouts happen. They are a part of the game and it's crucial to protect yourself from them. My tip: always wait for a confirmed breakout, ideally with strong volume. This increases the probability of a successful trade. Once the neckline breaks, you can project a price target, a reasonable expectation of where the price might go. Measure the distance from the head to the neckline, the vertical height of the pattern, and subtract it from the breakout point. This gives you a potential downside target. This gives you a guideline for potential profit, a benchmark to aim for. The neckline break is the culmination of the pattern, the final act in a carefully constructed drama. The trapdoor opens, the floor gives way, and the price begins its descent. This is where the head and shoulders pattern truly shines, becomes a powerful trading tool. It provides a clear signal and a defined strategy. Manage your risk and stick to your plan. Discipline is paramount in trading. The market has spoken, it has revealed its intentions. Now it's time to act. Execute your strategy with precision and confidence. Use this moment wisely. This is your opportunity to capitalize on the market's signal. That's the head and shoulders pattern, why it matters, how to spot it, and how to trade it. It's more than just lines, it's a story of bulls losing steam and bears taking over. If you found this helpful, hit like and subscribe for more trading insights. Share your experiences with this pattern in the comments. I'd love to hear your stories. Remember, patterns are tools, not guarantees. Combine them with risk management and discipline. Keep practicing, keep learning, and trust your analysis. You've got this. See you in the next video.